Hello guys, and welcome back to my YouTube channel. In this video we're going to be going over the basics of forex trading. If you're a beginner trader or you have never heard about forex trading, you're trying to get into it, I'm going to be doing this video. Is going to be part of a 3 to 5 part series on the basics and the fundamentals of forex trading. So without further ado, let's get straight into the video. So the very first question you'd want to ask, you know, as a beginner is, what is forex? Okay, I'm going to be giving you guys the key points. We're not going to be beating around the bush. We're going to be explaining everything, as quickly and straight to the point as possible. So, what is forex? Forex simply means the exchange of two currencies. For example, I'm from Nigeria, and if I'm moving from Nigeria to say Ghana, I'm going for vacation, I'm going to conduct business, I'm going to change my Nigerian naira to the Ghana cedis. Or let's say you're from the US and you're going to the UK for business, you change your dollar to the British pounds. As you change your dollar to the British pounds, that is basically forex in real time. But we as forex traders, we do not buy and sell currencies, the real raw currencies. We trade the fluctuations of prices, and that's what we're going to be getting into in a minute. So we have two parts of forex trading. We have the fundamental analysis and the technical analysis. Let's discuss the fundamental analysis, as that is pretty straightforward and easy to understand. Fundamental analysis simply refers to the news events of the world that could affect the markets. There's no need to try and remember all the news events by heart. So I use a free website to access all this information, and I'll share that with you guys right here. The website I use is called forexfactory.com, and I'll show you how it works over here. So to access, just go to www.forexfactory.com, and when you go over to forexfactory.com, you'll find this is not the settings you have. I'll show you guys how to filter out the news events to be like mine. Okay, so you come over to this green bar here, you click it. Here you find expected impacts. This red folder is for the high impact news, and this kind of golden folder is for the medium impact news. These are the news that we are concerned about. This yellow and ash one, they are for low impact news. So I turn this off and I turn these two on, and I click apply filter. So what this does is it filters out all the news that are not meant to have any impact on the market, and it brings up the high impact and the medium impact news. So you are aware of the news events that's going to be taking place in the market. Now, we are not fundamental traders. We don't trade off of fundamentals, but it's important to know, because when there's a fundamental event going on, there's usually a lot of volatility in the market. So if you have any pair, for example, now this, we can see that there's a news here on GBP and the USD, and the folders are red, so which indicates to us that there's going to be a high impact news. So you can expect volatility on these pairs. If you're going to be trading them, you're going to, at least you have an expectation, so you know what to expect. In my opinion, the news events to pay attention to are the NFP, the CPI, FOMC, PPI, and unemployment rates. These news events bring a lot of volatility and liquidity into the market. What I mean by volatility and liquidity is prices tend to move very quickly on those days. When you have NFP or CPI, if the market is meant to just move 20 pips or 30 pips, you would find the market pushing, because of the volatility of the news, you can find the market pushing 80 pips, 100 pips. So they carry a lot of volatility. So on the days of the NFP, CPI, FOMC, and PPI and unemployment rates, you will do well to position yourself accordingly and take note of those days. So if you know you are not ready for that kind of volatility, you either stay off the market or you can use it to your advantage. Let's break down some basic forex terminologies. The first one we'll be looking at is the broker. A broker is a financial service company that gives traders access to the markets. Remember that the forex is a multi-trillion-dollar company. So typically, only big banks and hedge funds should be able to participate. But the broker helps retail traders like me and you to execute our trades and participate in the markets. Broker sounds like a middleman that we go through to be able to participate and place trades in the markets. The next one we're going to be looking at is currency pairs. We have major, minor, and exotic currency pairs. But in this video, we're really not going to be talking about the exotic currency pairs because they are not really traded. Examples of exotic currency pairs are the USD ZAR, that's the USD South African Rand, the USD Mexican Peso, etc. like that. But we're going to be focusing more on the major and the minor currency pairs. Major currency pairs are pairs that have the USD attached to them, while the minor currency pairs are pairs that do not. Examples are the Euro USD, GBP USD, AUD USD, NZD USD. All these pairs are going to be looking at them more in depth as we go on further in the study. Minor currency pairs, example, are the Euro GBP, GBP JPY. Basically, all pairs that don't have the USD attached to them. Okay. So the next thing we're going to be talking about is PIP. If you listen to videos or if you listen to traders talk, you always hear them talk about pips. Oh, the market moved 50 pips, 10 pips, 15 pips, 20 pips. A pip is the smallest amount of movement on a currency pair. We make or lose money in Forex depending on increase or decrease in pip value. Okay, now let's go to the market. So let's look at how to calculate pips, how to use pips because the most important thing about knowing the value of pips is to use them to know how to calculate your risk and your potential reward. Okay, so let's look at live examples. For example, you're interested in this GBP JPY trade, and this trade is currently moving. I call it out in my Sunday weekly outlook. If you're interested in seeing that, just go back and watch the video. But let's say you're interested in this market. The market came down to your area of value and has given you an entry. Now, after you have gotten an entry, you need to know how much you are going to risk. How you calculate that is you find the pip value of your risk. So normally you're meant to calculate from the price of your entry to the price of your invalidation. That whole length is your risk. The tool I use to determine this is called the long and short tool. So I come here in the tool section and I select the long tool because I want to buy at this region. The reason why I want to buy at this region is the market has given us an entry. So we are going to use the amount of pips from our entry to our invalidation point to determine our risk. Now, there's a mathematical way of calculating this, but I don't use that. So this is a video that's going to show you guys all the things that you need to know. So once I take my long tool, I click it, I snap it where my entry is meant to be at. I drag my stop loss to where my invalidation zone is, over here. Right here it shows me 46 pips. Right now, this is the risk I'm willing to take on this trade. I drag this top end to where I want my take profit should to be. Here it says 224 pips. So I really do not need to calculate by mass The length from here to here, how many pips it is, from here to here, how many pips it is, because there's already a tool that could do that for us. So the tool I use again for the long is called the long tool. If we're going in the opposite direction, say I wanted to sell from this region, you can find here, it's called a short tool. Let me give you an example of that. If I click the short tool and say I'm interested in selling from this region right here, this resistance point right here. Bear with me, these are not real trades. I'm just like using them to give you examples. I enter the market here and I drag my stop loss to my invalidation zone. So it's up here. That's 33 pips. And I drag my take profits down to where my target is. This is 55 pips. Now you can see that this tool has simply given us the amount of pips for our risk and the amount of pips for our reward. So if I want to know the lot size to use, we'll simply go to right here. It says 33.7. I can edit this and just make it 33. So make it 33 pips. Okay, 33 pips. And I go to my Forex position size calculator. For the Forex position size calculator, I use myfxbook.com/calculator. You can just go to www.myfxbook.com, and under that you'll find position size calculator. You click that. Pair is GBP USD. I change this from here to GBP JPY. Sorry. The account size $10,000. The amount of pips, that's 3 pips. Calculates. As you can see here, the position size I'm meant to use is 0.46 lots. If I have a $10,000 account and I have a stop loss of 33 pips, the lot size I'm meant to use is 0.46. So with these tools, you can easily do make calculations on your trades and make an accurate position size instead of having to calculate by hand or doing the math of what the distance from here to here and how much do I need to risk. You can just simply use these tools. I've given you guys all the tools to use, the long tool or the short tool. Then you come to myfxbook.com and you do fill in the details to get the appropriate lot size. So the next thing we're going to be looking at here is leverage and margin. Leverage is an amount the broker loans you to participate in the market. For example, when you're signing up to a trading broker, you are asked what leverage do you want to use. There are always options: 1 to 50 leverage, 1 to 100 leverage, 1 to 500, 1 to 1000. That simply means any amount of money you put, the broker is giving you 50 times your capital to trade. Broker is loaning you, let me not say giving you. Broker is loaning you 50 times your capital to trade, 100 times your capital to trade. You can keep the profits you make. However, if you don't manage your risk properly, you may lose more than you intended to. Okay? It is important to note that the broker will not allow you to lose their money. They will automatically close you out before you lose their money. That is called a margin call. Now, I said leverage and margin. So now let's discuss margin. Margin is your buying or selling power. That is your capital plus your leverage equals your margin. For example, you have an account of $100 and a leverage of 1:100. It means you have a buying power of $10,000. This is your margin. This means you can open a position worth $10,000 because of your leverage. But remember, you cannot lose the broker's capital. Hence, you must manage your risk properly. We will talk about risk management and money management when discussing technical analysis. Say you have $100 and you open an account with a 1:100 leverage. That simply means, let me type this out so we all can see. $100, $100, and you have a leverage of 1:100. It simply means your margin is 100 times 100. When I say margin, just take it in your head as your buying power is 100 times 100, which is $10,000. $10,000. It simply means that you have a buying power of $10,000. It means instead of you to be able to open a position that only $100 can open, the broker will loan you this leverage. Now you can open a position that a $10,000 account can open. But you are not allowed to lose the broker's money. So it is important that you practice a good risk management. If you don't practice a good risk management, if you lose this $10,000, if you lose up to $100, the broker will automatically close you out. That is called a margin call. In fact, before you get to $100, the broker will automatically close you out. That's why you hear a lot of people preaching risk management, risk management, risk management. It is so important and it's so vital. So make sure you practice risk management. We'll discuss more about risk management when we get into technical analysis and all that good stuff. Now let's talk about spread. Spread is simply the difference in a currency pair's buying and selling price. It is the broker's commission for your participation in the market. It is how the brokers make money. You can easily check the spread on any pair by looking in the middle of the buying and selling price. Okay? If you look over here, this pair is GBP JPY. If you look here, this is the sell market, selling price. This is the buy market, buying price. In the middle right here, you see the spread. The spread currently at this point is 1.0. You see it fluctuates. This is the broker's commission. Okay? You find a lot of new traders or traders who trade on the lower time frame, the 1 minute time frame, the 5 minute time frame. Mind you, I don't have anything against the lower time frame traders. I have very good friends who are successful in those time frames, but it's important to understand what happens when, for example, you're trading a pair like GBP JPY and you have a 1 pip stop loss, but the spread on that pair is 1.2 pip stop loss. The market doesn't have to come and hit your stop loss before it takes you out, because the space that you left, the space between, is not enough to cover the spread, not because of give your trade breathing room. For example, see this position I have here on the screen. If you check for this red bar is the stop loss. The spread is 1.4. It means if this market should go against me, come down, and come to a point where is left for 1.4 pips to stop me out, it will automatically close. Why? That's the broker's commission. The spread will close it out. But say you are trading on the 1 minute time frame and your stop loss is just 1 pips, and you enter a market and the spread increases to 1.2 pips. Similarly, the market will not need to travel down all the way to close your position. The spread will automatically take you out, because you are meant to give a little bit of breathing room, 1, for spread, and 2, for your trade to actually move. So that's simply what spread is. Spread is the broker's commission, and the broker's commission is included in your risk. You have to include the space for this spread in your risk. So if you're someone, you have been trading the lower time frames and you complain of, the market, it didn't get to my stop loss, but it hits me out. Here is how to avoid such stop loss because of spread. Number 1, give your trade enough breathing room, especially during high impact news. When there is high impact news, these spreads usually increase. They increase this spread as 1.5, because this spread of 2 pips, 3 pips. So if you're trading on high impact news days and your spread is just 1 pips or 2 pips, you will find that the market, it might not get to where your stop loss is, but the market closes you out. That's because of spread. So look at the pairs you're trading and look at the spread that is on those pairs, especially on high impact news. Number 2, trade pairs that have low spreads. For example, the majors. If you look at the major pairs, the Euro USD, GBP USD, AUD USD, the spread on those pairs are usually okay. You can have 1 pip, 0.5 pip spread, 0.8 pip spread, because there's a lot of liquidity in those pairs, so the spreads are not usually wide. But you see this pair GBP JPY, the spread is fluctuating from 1.5 pips to 0.7, and it could even be more. Go to other pairs like Euro NZD, GBP NZD, some pairs like that, you could find crazy spread. And if you're trying to trade those pairs on the lower time frame and you're not looking at them, you're entering on the 1 minute time frame with a 1 pip stop loss. The spread can be as high as 2.5 pips, and you enter a trade and it automatically takes you out. That's because of spread. So trade pairs that have low spread, like the majors. Number 3, avoid trading the Asian session. The spread always widens during the Asian session because there's no much liquidity in that time period. Okay, the major times to trade are the London and the New York session. That's when the big banks are active. During the Asian session, there's no much more liquidity in the market, so the spread increases. Okay, speaking of sessions, let us look at the sessions that we have in the forex trading market. We have 3 major sessions in the markets. We have the London session. In my country, we currently use the GMT +1. So anytime I give here, you can just translate it to your own country, whether you're in Europe, Asia, wherever you are. You can just translate it to whichever country you are. This is the London session is from 6 a.m. to 2 p.m. GMT +1. The New York session is from 2 p.m. to 10 p.m. GMT +1, and the Asian session is from 10 p.m. to 6 a.m. GMT +1. These are the major sessions we have in the forex market. Now, if you remember when I spoke about spread, I said avoid trading the Asian session. Try your best to stick within the London and the New York sessions, especially if you're trading on the lower time frames, to not have those spreads stop out. Like I said, this is the first part of a 3 to 5 part series. So in the next part, we'll cover technical analysis and some other topics we need to cover for the basic traders. Thanks guys, thanks for tuning in. If this is your first time watching my channel, do well to subscribe, like and comment down below. I'll be doing more of this series to try to help the beginner traders to catch up, so that you can be able to understand when we do our market outlook and trade breakdowns. You'll be able to understand some of the terminologies we are using and everything about doing here as traders. Thank you, and I'll catch you guys in the next video. Cheers.